Good morning, it's Jonathan Barrett, just discussing the oil market and also a little bit on the oil review which we just put out actually last night. Quite a large correction on oil last night as well. Reached those highs, the higher end of the range, which is up around through that 85, and we're seeing it down to 81.40 at the moment. So quite an aggressive stance. What I thought I'd actually do is talk about oil and why there is perhaps a substantial top in place. I think there's a lot of misconception out there at the moment concerning what oil is actually doing. There's a lot of that stimulus trade which people are looking at, weakness in the dollar, all those sorts of things. And in the oil review, we sort of broke it up into pretty much three aspects. But let's have a look at the chart first. There it is there. That's the daily chart for crude. And I guess in my mind the idea is to talk about what's happening in the fundamental side, talk about what's happening in the technical side, and then talk about which instruments you can use to actually trade it. So in the review, I think it's not too bad, but the review is there to let people know what we're actually feeling at the moment with the actual market. Okay, look, I guess if anything, you can see that we've been in this long range for quite some time. Really hasn't done too much either way, and I think it's not a bad thing when you look at it to see that the market is quite happy to be range bound, particularly as we're trading through issues, obviously of the economic recovery. Now the interesting thing here is that the market has failed to move onwards or upwards, or in fact failed to move higher, even though we've got an exceptionally weak US dollar. And to me that is quite interesting. And when I certainly look at it, I feel that it is well, fundamentally I think it's actually holding up quite nicely. But given that, we still feel that it is in the range. Now, one of the reasons why the market has actually traded higher, we had some surprise data from the EIA concerning inventories, and that sort of put people a bit unaware of what was actually occurring. But before we go into that, I think it's important that we really talk about the summer, what's occurred there, and basically through that summer drive time, we've seen the market sort of really do nothing, but as a result of that, we've been left with a legacy, and that legacy just so happens to be stocks, which are higher, 5.7% higher than where they were last year, and we've also seen gasoline stocks up about 5.3 from where they were last year. Heating oil, exactly the same thing. So really the summer holidays, the summer drive time in the States pretty much did nothing but leave a legacy of higher supply in the market. But as you can see, the market actually didn't go lower. In fact, it went a little bit higher. That indicates to us it's a big support. But why do we think the market went higher? Well, we have seen draws. Just last week, we had draws of 500,000 barrels. And basically, that suggested that the people thought that, hey, we've got a problem, things are going to trade higher. We are at levels not seen for over 25 years in terms of supply, so it shouldn't be too much of an issue in terms of where the market is. In fact, the market should be a lot lower. But with these inventory draws together with the stimulus that a lot of people are looking, the quantitative easing, we actually saw the market stay a little bit better bid. The US dollar weakening, QE2, all these areas indicated there would be some support to the market. So in my mind, that is quite supportive. Also, the fact that we're looking at weather and the changeover into the cooler months of the year suggests that we're going to see more demand for heating oil, and as a result of that, people are actually moving. So moving the market higher. So that in itself gives us a sense of that the market should be trading a lot higher, but it really, in retrospect, it really shouldn't be. Stocks are at major highs. The recent move we've just had is purely on the back of a drop in inventory, but that's something that is seasonal. It's a seasonal change to refinery output. That's when the refiners switch from producing gasoline to producing heating oil. And as such, we do get this fundamental shortage and this fundamental draw because of the change. So if you're buying crude purely on the back that this should be trading higher as a result of the demand, well then it's the wrong thing to buy in it for, because you shouldn't be, because this is just a temporary thing, and give or take another couple of weeks, it'll all come back to normal, and prices should come back to normal as a result of that. We should go back to just normal supply, and as a result of that normal supply, then the prices should start to come a little bit lower over time. Right, okay, now looking at that, US dollar, slightly weaker. That has been weak for some time, and you can really see that US dollar a lot weaker here. There it is, right on those lows there. That area should hold. If in fact it does hold here, then you know that it should start to firm up. Now we have been weak for some time. Good support here. That should hold, then the market should trade higher. Now the dollar has been weak purely on the back of the quantitative easing, and on that quantitative easing, people have decided that more dollars in the system should be a little bit more economic in terms of stimulus, and as a result, crude should go higher. But that weakness in the dollar, I think, should turn around. But when we do look at where the market is, you know, I feel, in fact, it's doing the opposite. It's basically saying we're not having demand. And as a result of not having that demand, supplies will eventually pick up. So, in a nutshell, I actually feel that the top end of the range for crude is around 85, 86, and I think we're basically in the range. A breakthrough 86.20 is the one we mentioned in our review. Then we should actually trade quite substantially higher. The old range is 86.80 on the top side, 67.17 on the downside. So if anything there, we feel that the rally which we've had should be short-lived. The market should fall back into the range again and probably end up trading a little bit lower rather than higher. And I think that's the trend we've had. Now, how do we actually trade that? How do we actually trade if we feel we want to be short in the market? It's quite simple, really. That's the daily chart. That's the highs, and we've come back. That area there at the top is an area where you'd put a stop if you're going short. And I feel that that's something to keep a good eye on, because if it did break through that area, then we're wrong for some reason. But just have a look here. The best ways to trade it are either through a CFD, and all we have to do is put oil in here, and we actually get the oil for December. Could be UK or US, and you can actually trade it via barrels. So it's quite an easy one to look at, and quite an easy trade to look at. Just a matter of just hitting it, and off you go. Or you can actually trade it via the futures, and trading the futures there, it's just a matter of typing it in there, and off you go. Same sort of contract there, a little bit different. One thing to note of trading the two, trading the CFD is a lot easier because you can don't have to trade the full 1,000 barrels. You only in fact have to trade a smaller amount. And for some people that don't have a lot of capital, just trading a small amount is perhaps the best way to go. So, as you can see, what we do is we feel that there's a correction in the crude market, something we mentioned in the report yesterday, that we feel that things will start to come under pressure. And for those reasons, we feel that the market is still in a range. And if it is still in a range, the best way to trade it is via the short side with a stop, whether it's a future or CFD. But the stop has to be in a particular area. And I think at the moment, you can quite happily sell from here or up to 82 or 83, but the stop must go in at 84.20 or at 86.80. So in my mind, the volatility's there, but that's where I think you should put the stop. So I guess just quickly, crude, we still is in the range, and as a result of being in the range, it's a range trading opportunity, and as a result of that, then I think that rallies can be sold. Stops, you know where they are, and you can trade them via the CFD or the futures. Keep an eye on the inventory data that comes out every week, particularly in the States, and that should give you a bit of an idea. Expect some draws to occur, but overall with these draws, I think expect to think that because we're moving from producing gasoline to heating oil, there should be a little bit of shift. But also remember, stocks in heating oil are also very high. So there's not going to be too much of a problem in terms of demand for here. So as a result of that, probably expect any rally to be short-lived. And as a result of that, happy to trade the range. Let's see, the downside target for this would have to be back through that 78 or even 75. But let's see how we go. So that's about it for oil. That's our oil review. If you want a hard copy of it, just feel free to call anyone within the company, and they should be able to provide it for you. So have a good, happy trading, and we'll talk to you next couple of days or next time we have a good review.